Hi everyone, Paul here with Gamma Edge. Today is Saturday, the 30th of April. Want to talk a little bit about the JPM Fund 2 roll that just occurred, so let's go ahead and get started on that. Before we do, please pause this, read it. It's important to you, it's important to us. When you get done, go ahead and hit play. So for those of you who are not familiar, JPM has 3 hedged equity funds. They roll at the end of each of the months. There are various sizes as indicated here. We just completed the roll yesterday of Hedged Equity Fund 2, the yellow, here at the end of April. And now the new date for that will be the end of July. And so the idea behind this is that if you wanted to have somebody manage your money, excuse me, you could go to JPM and get in at the end of every month, and the structure we're going to talk about here today will be available to you. The generalized structure is pretty straightforward. Basically what happens is if this is spot price, what they do is they choose a long put 5% below the spot, and then they go down 20% below the spot price and they choose a short put, and this is called a collar. And this P&L graph here shows that once you get down below 5% below spot, you start making money in that long collar. And what they do is they adjust a short call up here to pay for the cost of the debit of this long put. So effectively, you can put this trade on for zero cost. And if you are hedging your portfolio, this can be a good thing. So this is the overall structure. It's important just to kind of get the P&L in your mind's eye, because we're going to talk about it here. When you bring your portfolio to the table, if it's correlated with whatever you did in the underlying, in this case it's the SPX, so they are long the SPX, and then they have this hedging structure. If this is that spot price right here, what happens with that short call up here, the long put here, and the short put here, is that they cap their upside 3 to 5% roughly. They have 5% downside potential, and then from this level on down to here, which is 5% below spot, down to 20% below spot, or approximately 15% here, they are basically flat, and so they don't see the market fall down. And then below that 20% point, they have unlimited downside as the market continues to fall. The idea behind this and the reason JPM does this is that in looking at corrections or pullbacks, most of the pullbacks are in this particular range, but you want to give it some ability to participate both on the downside as well as the upside. So when we take a look at that, recall there are 3 funds, and they mature or roll every 3 months. We just completed the April yesterday, so now it goes out to July, and the new structure is shown here. I've also posted this in various places, but this is the new contract structure. We're now in May, or we'll be looking at the May contract, and we're going to talk a little bit about this. I want to point out a couple things. Relative size, the May contract is smaller than the July contract and much, much smaller than the June. June is the flagship. This was Fund 1. You can see very, very large size, very dominant in what's coming up here. I'd like everyone to realize the contracts are not liquid. They don't change them during the quarter. Once they are into them, they are sticky. We call these rocks, and basically these become underlying structures within the overall complex, and they don't move. All they do is roll on the last day of the month. So let's take a look in some detail now what's transacted, so everyone has a good understanding. So they rolled the ones that expired yesterday, and the new strikes are shown here. So basically we've got a short put up at 32.90, which is right here. We've got a long put 39.10 here, and then we've got the short call indicated here at 43.60. So this would be approximately 5% up, 5% down, another 15% or 20% below where the spot price was. And they put on 12,700 contracts for the July end of month. So this is the new structure. The lines that you see here, these interim lines, are the profit and loss intra-trade, and you can see those up here in these dates. The blue line is where the profit and loss will eventually collapse to, depending on where they are in the overall timing of the structure. So if the SPX goes up in price, the actual value will be here. If the SPX goes down, it'll be up here, and you can see how that works. So when we bring a fully hedged portfolio to the table, which means that all of the contracts of the SPX are fully hedged against this structure, you get something that looks like this. And again, if the spot price is here, here's the upside with the short call, here's the long put, and then here is that short put, and you get the structure that I showed earlier. The actual numbers as they come out for what occurred yesterday are about 5.5% to the upside, which is a little bigger than they normally do. About 5.5% to the downside, and then approximately from spot price, approximately 20%, 20.4% all the way on down to this 32.90. The gray line is the current pricing, and what happens is as we advance through time, we advance from gray to green to red, and eventually we will collapse at the end of July on this overall blue line, and then the roll will occur again. It's important to understand where the delta lies in this. And the reason that that's important is that the deltas that we have here, you can see minus 100, so on a per contract basis, this is where we're rolling in at. And this is where that short call is. This is where the long put is and where the short put is. And you can basically see that there is no hedging going on in this area. So we have full market participation. 5% up, 5% down, and then from this area down, which was that 15% bandwidth, or 5% to minus 20% here, and you can see why. So in the limit of the delta, this is the curve that we're playing with. But what's important here is that this is today's price, or yesterday's closing price, 41.31, and where it intersects the gray line, which is right now, as you can see, gray line, it's the now price. We bring that over on a per contract basis, and it actually shows us the actual delta that is relative exposure to the market. And so for every contract that JPM put on in Fund 2, they're net negative on their delta, about 56. A little busy here, but this is the same graph. Now I've overlaid it with some other things, so that we're going to pick up there at that minus 56 that I just talked about, and you can see that being brought over here. So the circle 1 is the right now. The gray line, as I said, is the we are here, end of day yesterday, and so where those intersect, we come across, and we've got that 56.41 per contract. So JPM times, when we multiply that by the 12,700 contracts that they put on, they are creating, with this trade, a 7,100 contract imbalance, as you can see here. So the JPM trade has forced the dealers into a positive long position through this trade. So if we're negative on JPM's side, remember the dealers are on the other side of the table, and when the dealers are on the other side of the table, they're net positive on those deltas. And so in order to offset this, JPM bought approximately 7,000, a little bit more, of the 4,000 strikes with a delta of the 0 DTE. And they did this so that there wasn't, at the time of the transaction, there wasn't a big dislocation in the market. The problem with this is that they didn't put this on until after 3 p.m. Eastern time. And the other problem that exists with this is this was a 0 DTE. So at the end of the day, this trade imbalance still existed, because remember, these don't expire until July 29th. So even though the transaction was netted and zeroed, at the end of the day, the dealers were still way too long by 7,164 contracts, at least by my calculations. That's a pretty big imbalance. It's about $2.9 billion worth of imbalance in this particular case. So all that being said, it's no surprise to me that we sold off, and that we can use this information to understand kind of what the bias is. This is why we put the videos out yesterday, and why I'm putting this video out today. So the question that we often get now is, so what? So now that the trade's on, what does it mean in the big picture? So this picture is looking here again at Delta, and you can see that I've isolated only the dates that are in May. So I'm looking, right now, of course, on the 30th of April. We've got the 10th of May, the 21st, and the 31st. Now we have an expiry. It's a different expiry, but we have an expiry at the end of the month, and that's important because that expiry causes these dislocations, or it causes the delta. So if I take all of the trades that are out there in the market, now the SPX is one instrument, right? So let's take all of the funds, funds 1, 2, and 3, but let's look at it just for the month. Here are the basic transitions that occur in Delta due to that end of May expiry, right? That's Fund 3. It's the smaller of the funds. And you can see that we just, with the right now line here, we just went to the left of this level. So this 4135 level is a pretty important level for us to pay attention to. So when we're to the left of this line, deltas tend to drop in the structure below that 4135. Now remember, they have a short put down here at 3490. So you can see the gray line goes to the green line, goes to the red line, and eventually by the end of the month will collapse into the blue line. So the natural bias, if we remain below 4135 for the JPM structures, is that we're going to have more negatively increasing deltas, which are going to force the dealers longer, and all things being equal, they're going to hedge by selling. If we're above the 4135, you can see what's going to happen here. You can see that we're going from the gray to the green to the red and here to the blue. And so we're going to actually move upward, and we're getting less negative in deltas, meaning we're getting longer. Less negative is getting longer. That means the dealer is actually getting shorter, and this could actually affect some buying as we go if we're higher than at 4135. So we think the 4135 is going to be a very key level to watch for the month of May, and let's pay attention to that, right? Not necessarily saying that it's a perfect indicator, but it's a structural impact. We just witnessed yesterday a structural impact. I think we're going to see another structural impact due to this throughout the month, so let's keep our eyes on that. So what are the takeaways here? So the hedge funds 1, 2, and 3 collectively are about 26 billion in size, right? So that they're big, but they're not as big as the SPX. The SPX, both the AM and PM notional value, is about $5 to $6 trillion, depending on where we are any one given day. So this value, although it's huge in context of the daily moves, in context of the complex, is not. So when we see these major dislocations due to Delta, to JPM doing what they're doing, they're causing market shifts, but they're not really impacting the SPX in any large sense. The end of month expiries that we just went through yesterday, we think they probably do matter, and we want to pay attention to them. This is probably one of the most asked questions that we get at Gamma Edge. We think it can pay handsomely to understand the mechanisms that are going on and know the net biases of where we are, hence why I've presented them to you. Note that the structure being discussed is for the hedge for the next 3 monthly expiries. Also note there are a lot of other trades out there, big rock trades, right, that are considered illiquid, that people are holding to the end of the month, or the monthly expiries, the AM expiries, etc. And they all add up. Now, I've only given you a glimpse of this, and there's another video that we did here at YouTube that talks about when you combine everything together and what it looks like. But just be aware, this is just a glimpse of a model. This is a toy model, as some folks indicate, but that toy model definitely gets us in the right playing field. It gets us pointed, looking at home plate, and it actually helps us understand exactly what's going on. And so I think it's absolutely worth your time to follow this. So with that, I'll leave you. If you're interested in this, we talk about this and a whole bunch of other things at gammaedge.us. We have a Discord that will take you to a sign-up page that will get you into the Discord, 14-day free trial, all the tools turned on. We have a great voice channel. We have a lot of tools there to slice and dice gamma, and would urge everyone to come in and kick the tires. Follow us on Twitter, Gamma Edges with an S. And then, of course, if you like this content and all the other content that we put out, please hit the like button and follow us. And you can bookmark this. Note the C in there. That'll land you right on our area, and you'll be able to look at the different videos. So with that, make it a great weekend, and hope to see you in the Discord sometime in the near future. Thanks, everyone.